It wouldn't start with panic. That's the part most people get wrong. No alarms, no breaking news banners, no dramatic music. Just a few people logging into their banking apps on a normal morning and pressing withdraw. At first, nothing feels unusual. The money is there. The numbers look intact. Balances haven't changed, but behind the screen, something is already off. Because if everyone tried to withdraw their money at the same time, the system wouldn't just struggle, it would fail. Quietly at first, then all at once. And by the time you noticed, it would already be too late. Now here's why this matters more today than it did a decade ago. We live in a world where money feels instant. You tap a screen, you move thousands, you send across borders in seconds. It creates a powerful illusion that your money is always there waiting, available, liquid. But the truth is more uncomfortable. Your money isn't sitting in a vault with your name on it. It hasn't been for a very long time. And once you understand what actually happens behind the scenes, the idea of everyone withdrawing at once stops sounding hypothetical. It starts sounding like a stress test the system is quietly hoping never happens. Let's slow this down. You deposit money into a bank. Let's say $1,000. Most people imagine that $1,000 sits somewhere safe, maybe digitally recorded, maybe physically stored. Either way, untouched. That's not what happens. The bank keeps only a fraction of it, sometimes 10%, sometimes less. The rest, it gets lent out to businesses, to home buyers, to governments. Your deposit becomes someone else's loan, and that loan becomes someone else's deposit, which then gets lent out again and again. This is how the modern banking system expands money. It's efficient, it fuels growth, it keeps economies moving, but it comes with a trade-off that's rarely talked about. The system only works as long as not everyone asks for their money back at the same time. Now imagine this. A rumor starts spreading. Maybe it's a large bank reporting unexpected losses. Maybe it's a geopolitical event. Maybe it's nothing more than uncertainty. A few people get nervous. They withdraw their money. The bank handles it easily. That's what reserves are for. But then more people hear about it. Withdrawals increase. Lines form, digital or physical. Now the bank starts feeling pressure. Because while deposits are liquid, loans are not. A mortgage can't be called back instantly. A business loan can't be reversed overnight. So the bank faces a mismatch. Short-term demand for cash, long-term assets locked in place. This is where things begin to crack. At a certain point, the bank has to make a decision. It can try to sell assets quickly, but fast sales mean discounts. Losses start appearing. Confidence drops further, which triggers more withdrawals. And suddenly the problem isn't liquidity anymore, it's trust. Because banking isn't just about money, it's about belief. The belief that your money will be there when you need it. Once that belief weakens, the system accelerates toward collapse. Not slowly, exponentially. Here's the uncomfortable math. Let's say a bank holds $100 billion in deposits. It might only have $10 billion in actual liquid reserves. The rest is tied up. So if even 20% of customers try to withdraw at once, there's not enough cash, not even close. And this isn't a flaw in one bank. This is the structure of the entire system. It's designed for normal behavior, not synchronized fear. Now zoom out. What happens if it's not just one bank? What if it spreads? Because in reality, banks are deeply connected. They lend to each other, they share exposure, they operate in the same markets. So when one bank shows weakness, others are questioned. And questioning leads to caution. Caution leads to withdrawals. And withdrawals lead to pressure everywhere. This is how local problems become systemic events. At this point, something else happens. Governments step in. Central banks inject liquidity. Emergency lending facilities appear. Interest rates might shift. Regulators issue calming statements. The goal is simple: restore confidence before panic becomes reality. Because once a full-scale bank run begins, it's incredibly difficult to stop. Even if the underlying system is technically stable, Because perception moves faster than policy. There's a strange irony here. The system is fragile in the short term, but stable in the long term. It survives not because it's indestructible, but because most people don't test it at the same time. Trust isn't just a feature of the system, it is the system. Now compare this to what people believe. Most assume banks are just storage. Safe, passive, predictable. But in reality, banks are engines. They transform deposits into movement, into risk, into growth. Which means your money isn't idle. It's working somewhere you can't see. And that's fine, until you want it back immediately. Let's take this one step further. In a world where digital banking dominates, bank runs don't look like long lines outside branches anymore. They happen in silence. Thousands of withdrawals per second, no visuals, no warning signs, just numbers moving. Fast. Faster than any physical system was ever designed to handle. Which means modern bank runs can escalate far quicker than historical ones. What used to take days can now happen in hours. So why doesn't this happen all the time? Because of safeguards. Deposit insurance. Central bank backstops. Regulation. All designed to maintain confidence. To convince you that even if something goes wrong, you're protected. And to some extent, that's true. But these protections have limits. They rely on the same thing the system relies on. Controlled behavior, not mass reaction. Now here's where it gets uncomfortable again. If everyone tried to withdraw their money at once, even deposit insurance systems would be overwhelmed, because they aren't designed for universal claims. They're designed for isolated failures. The system assumes problems will be contained, not synchronized. So in reality, the system doesn't need everyone to panic. It just needs enough people to act at the same time. That's the threshold, and no one knows exactly where that line is, because it shifts based on conditions. Market sentiment, interest rates, economic stability, it's a moving target, invisible until it's crossed. And yet, despite all of this, the system continues to function. Day after day, year after year. Because most of the time, people don't think about it. They trust the numbers on their screen. They trust the process. They trust that when they press withdraw, the system will respond. And most of the time, it does. But that trust is built on a quiet assumption that not everyone will ask the same question at the same time. What if I want my money now? Because if that question ever becomes collective instead of individual, we wouldn't just be watching a financial event. We'd be watching the limits of the system itself. Not breaking loudly, but revealing something it was never meant to hide. So the next time you check your balance and see a number that feels solid, stable, real, there's a deeper question sitting underneath it. Not about how much money you have, but about how much of it could actually be there if everyone else decided to ask for theirs too. And more importantly, how close we ever get onto finding out.